Hello everyone, David and Richard here with another Ask the Lender show. Today, David, what kind of topic do you have or a question do you have for our special guest, Rudy Gonzales from Summit Funding?
All right, we got a good scenario for Rudy today. It involves a paid off primary residence. This person looking to purchase an investment property, whether it's a duplex, single family, fourplex, whatever it may be. So paid off home and wants to purchase a investment property, of course 4 units and under. So what are some of the options or scenarios he could do to finance that purchase, Rudy?
Yes, so there's a few options. The first option is because that current property, the primary is free and clear. This buyer can pull out all that cash out of the existing, whether if it's a home equity line of credit or a cash out refinance. And because it's a primary residence, rates are lower on a cash out refinance for primary versus investment. And so he can utilize that full amount to purchase that new investment property cash.
So what's the max he can pull out of his primary residence?
80%.
Okay.
80% loan to value.
80% of the value of the house.
Right.
All right.
Correct. And so that's one option. Second option is we can, again, it's case by case, but as we review the numbers for this specific buyer, we can pull out 20 to 25% cash out and then just utilize enough funds from the existing property to buy, that investment property. And now he has a loan on both the current and the investment property.
Pull out enough for a good down payment on the
correct
investment. Okay.
On the investment. And the third option is pull out maybe even just 50%. So now he has two loans, one loan on his existing property, primary residence, and then he finances just maybe a portion, maybe half or less on the investment property. So again, it's case by case. We can definitely compare and look at the numbers, but it's always general rule, cheaper, less expensive to pull the full cash out of your existing property and buy an investment property cash, all cash.
Gotcha.
Yeah.
Three good options there. Just like you said, the primary gets the better interest rate and the better price. But I guess if on that 50-50, if the rent will pay it, and then that's a payment he's still used to, that one can work pretty good too.
Right. If it makes sense where, that monthly rent, it's paying for itself by this tenant, then this might be the better route. And again, there's a lot of details that go into it, but that's where we're here for, to kind of analyze it all and help out.
Yeah, you really want to break down each of those scenarios to see what works best. But you guys mentioned it. For me personally, if I would want the cash flow of the future property to not only cover all the expenses, but including the new mortgage you have on it, plus get some positive cash flow. So that might be the scenario of like 50% down on the new purchase and keeping 50% pull out cash on the primary residence. So you really got to play the numbers to see which scenario makes the most sense.
That is correct. And also if your existing property has a loan and you're actually upgrading for a primary residence, you're going to rent out your existing. That's also something else that we can look at. And then you can just pull out enough from your existing to buy your proposed primary residence and make it make sense to where the current tenant, or the future tenant, I should say, will be able to cover that current mortgage on your existing property. So several options. We're here to analyze your specific scenario and give you options.
Right on. Good question. Good topic today. Thank you guys so much for watching our Ask the Lender program. It comes out every other Wednesday here in the Stockton Area Realtors Group and beyond. So thanks for watching.